Good morning. I'm Mehdi Sunderji and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. As you know, or at least you should know, Jeff is the founder of the widely followed Huge Insights newsletter. You can actually find the newsletter on Substack at hugeinsights.substack.com, and it's also down here for your easy lookup. He does publish on a Sunday, and today's obviously Tuesday, so you get a good head start with Jeff's newsletter. So there's always lots to talk about, and a lot can happen, as we've seen today, between a Sunday and a Tuesday. So news-wise, market action-wise, a lot can happen. So make sure you sign up. Jeff, welcome. It's always good to have you.
Great to be here, Mehdi. Thanks.
And as always, let's dive right in and kick off with the top down.
Yeah. So what are we thinking? At the end of the day, I think a lot of the action that we've seen in the last week was leading up to, the CPI number that just came out. It came out a little bit hot. The Cleveland Fed does, a CPI nowcast. So they're taking into account all the, real-time data to try and forecast what the CPI is going to come in at. I think the more important number is really the core CPI. It came in, quite a bit above last month's. It was expected to be up somewhat. There is some controversy about the way that the CPI is now being calculated. That has changed. But, all said, there's no way that anyone can look at the data that was released today and say that it was a beat. It was a clear miss. It was hotter than expected, both on the core and the headline number. And without going into the nitty gritty there, I think the implication is for potentially higher yields and a peak in stock prices. And so, we've been kind of advertising that to our subscribers. We've been looking for the market to put in what we believe is a counter trend, advance terminal point, and so we came to the conclusion on February 2nd that the 41.95 level in the S&P was very likely the end of the counter trend, and that we should be looking for the market to start falling precipitously over the course of the next few weeks in what we've described as a third wave decline. And so, that's the message that we continue to broadcast to our subscribers. And, the net is we want to be de-risking portfolios here. We would like to see, investors minimizing net equity exposure and maximizing cash reserves for the time being.
Great, thanks for that, Jeff. You also, in this week's note, you highlight, I guess, reversal seems to be the key here, right? And you kick off with a trend reversal in rates. Can you walk us through this?
Absolutely. So, I think a lot of this counter trend advance that we've seen off the October low was macro driven. It was driven basically by a topping process in rates, which began late October and ended in early November. And we saw the 2-year kind of hit the 473 level. That marked the top in late October. We've seen the recent lows achieved on January 18 across the yield curve, 10 years, 5 years, 2 years, the belly of the curve, basically. And so, when we think about, where rates could be, we thought, well, January 18th was a low. We actually made a higher low on February 2nd, just as stocks were topping. And so what it tells us is that, there's that inverse relationship between rates and equity prices is starting to come back to the fore. As we all know, 2022 was a year where that relationship broke down and stocks and bonds fell together hard down 20% basically in each category. And, now we're seeing that disparate sort of, contra relationship that has historically existed between stocks and bonds reassert itself. And our sense is that this is what we can look forward to in the weeks and months ahead is a divergence between stock and bond prices here. And here we're seeing it as yields break out above a falling trend line. And in the case of the 2-year yield, we've actually broken out above its recent chart resistance high. And so, these rates came down. They tested their 200-day moving average. In the case of the 2-year, the 100-day moving average, they held. They're now reversing above trend resistance in the case of the 2-year chart resistance. That's a relationship that we think equity investors should be paying close attention to because it likely marks a reversal in stock prices to the downside.
So that's the rate side. Now, another real focal point for the last 12, 24 months has been the US dollar. And a lot of last year's market weakness coincided with that strength in the US dollar. And then we saw a reverse on the subsequent rallies off the lows in the market. Again, the reversal in the US dollar. Are you looking for the dollar to strengthen again?
Yeah, no doubt. Exactly what you said is what's played out. Okay, we saw massive strength in the dollar as rates rose. In fact, the dollar actually began to top in late September ahead of rates. Okay, so it was the leading indicator of where rates were headed, and it has since declined by 13% into its February 2nd low. It basically bottomed concomitant with stocks topping. So, that was a coincident event. And since that time, we've seen a reversal to the upside in the dollar off of those lows to recover above a short-term descending trend line, above a chart resistance line, and above its 50-day moving average at this point through yesterday's close. And so, the question at hand is, are we seeing a reversal in these macro factors that really drove the advance in stocks off the October low? And if we're seeing that reversal, will it coincide with the decline in stocks as we've been forecasting? And the answer, in our opinion, is yes. But of course, all will be known in the fullness of time.
So let's pivot to on the commodity side, like crude oil, right? So crude has obviously been a focal point for everyone, purely because it affects everyone. Crude oil yesterday, we saw the administration actually said they were going to tap the strategic oil reserves again. There was a headline out about that. At some point, surely that runs out and they're going to have to refill the tank. But do you see the price of crude rising here?
Our work is pretty specific. And, we looked at a chart of crude prices off the April 2020 lows. And what we saw was that over the subsequent period of time into the March 2022 high, the price of crude advanced from something like $5 a barrel to 130.50 cents, where it topped. And that advance occurred in 5 waves. And so we call that a motive wave in Elliott wave parlance. It subsequently fell in 3 discernible waves in A, B, C, and retraced 50% of the advance, which is a very common reference point in Elliott parlance. We'd also note that it held support at its 200-day exponential moving average. Now, over the course of the past, say, 4 to 6 weeks, we've seen a basing process. And that basing process appears to be developing as a cup and handle base formation of some magnitude. We've also seen the price of crude pressing up against what I would define as chart resistance and actually pushing up above it. And so we've seen a breakout above a descending trend line. We've seen the price of crude challenging chart resistance from a recognizable classic pattern base formation after retracing 50% of that advance and holding its 200-day exponential moving average. Our position on crude is basically that if in fact crude can break out from this base, then we should see a rally in crude prices to around $96 initially, potentially as high as $125. Now, that being said, if we take a look at the actions by the administration in the past, they have put pressure on crude prices by releasing SPRs. That is what brought the price of crude down. I mean, I think it got overextended. There's no question at 130, it was a reaction to war, that sort of thing. But what we're actually seeing is within the fundamentals, We're seeing the supply side contained by the major producers. We actually saw a production cut out of Russia because they can't make any money with the caps in place. And so, at the end of the day, we are going to be supply constrained. There is some demand pull coming from China now. If China does reopen, and I mean, it's a headline sort of thing where, it's off again, on again, but eventually China will reopen and there will be incremental demand for crude and supplies are being curtailed. That supply demand imbalance directly ties to a rise in crude prices. So our view is that, the breakout above the current highs that we've just seen recently in the past 4 weeks should resolve to the upside and extend to, around the mid 120s area would be our target. If we break back below the 200-day moving average, then I think it's time to pull the plug on that trade. And that would be where we'd stop out at about, say, $73 a barrel.
Great, got it. And how about let's have a look at the technicals on the broader market. You obviously discussed in great detail in your weekly piece the bigger picture side of things on the S&P 500. Can we have a look at the short-term picture?
Yeah, let's just talk about this counter trend advance that we've been discussing here off the October low. The chart will show, really looks at all the price action since the August peak on August 16th. And that decline into the October low was a clear 5-wave decline, which suggests to us that we're beginning something, not ending something there. And so the rally off of that October low has been very choppy, very overlapping, and it's been very lengthy in duration and been, more or less lateral to almost like a 45-degree angle to the upside, right? But it's occurred in 3 discernible waves, which we've defined as wave W, X, and Y. That's a double zigzag in Elliott wave parlance. And the reason we count it that way is the advance into the December high also came in 3 waves. And so that was A, B, C. The pullback to the December low was an X wave, a sharp 3-wave downturn. And then the rally that we've seen into the February highs, or I should say the February 2nd high at 41.95, that also occurred in 3 waves. And A, B, C, the C wave is most important to us because it's been what we call as an ending diagonal triangle, where we see prices kind of move up in a channel, and that channel actually converges, and prices break out above the upper channel line in what's known as a throwover, and then reverse back below it and below the lower channel line. And we've seen all of that play out. That tells us that we've got, something of a material top in the S&P 500 at 41.95, and that the price action that's followed has been 5 waves to the downside, followed by 3 waves to the upside, followed by what again looks like 5 waves to the downside. So, we're kind of looking at this as the beginning of, at least a minor degree motive wave to the downside, which should be the beginning of intermediate wave 3, a primary wave 3 down, which is what we've been calling a third of a third wave decline. We think this decline could carry prices all the way down into the mid 2000s. We've put out a range and we're published on this, a lot of different sources, a high of around, say, 2750, a low of around 2400 for primary wave 3. A lot of people are looking at that saying, it's not likely, it's hyperbole, you're calling for a crash. Well, we're not calling for a crash. The market is calling for a crash. The market is set up for a crash. And as we've gone through in past interviews with you and publications, we've talked about how sentiment has really recovered from the depths of despair and is really reaching levels that, are consistent with this sort of a technical framework.
I always get very nervous when I start hearing the 2000 handle on your levels. Where are we with the market internals?
Market internals are clearly weakening from their peaks. And in fact, what I would say is they're reversing from their peaks. We look at 5-week moving average data. Basically, this is our short to intermediate term internal moniker. And we're taking a look at 3 different internal relationships. The first is breadth. That's the top frame here. And the breadth of relationship that we're looking at is 5-week moving average of net advancing issues. That made a high and then made a subsequent lower high, just as prices were making a higher high. That's a negative divergence. That negative divergence tells us that it's marking a turn, marking a trend change potentially. We've also marked a reversal in momentum. Momentum got slightly overbought, never took out its higher high. It took out, the November and the August peaks, but didn't quite get as overbought as it had been in the past, particularly back during 2021, as the advance was under full swing. And so, we were a little skeptical, especially with all the talk in the media and on the Twitter sphere about breakaway momentum and breadth thrusts and things of these natures that are technically correct, but not necessarily. You can't necessarily draw the conclusions from that data that have been drawn. And in our view, the reversal that we've seen in momentum back into the neutral zone suggests that momentum has peaked and is rolling over. And then finally, net advancing volume. Net advancing volume last week was just around 50%. Okay. That's actually pretty good for a down week. We're down 1.1% in the S&P. And again, this is just S&P volume. But the thing that I think is more important is the 5-week moving average of up to down volume. That peaked at around 9, had been as high as 8.5 times last week, and has collapsed to just below 3 times this week. From that, I think we can draw the conclusion that net advancing volume has peaked and is now rolling over. And so all of these internal statistics have seen the zenith of their strength at this point, and we should expect to continue to see a weakened outlook for these net advancing figures.
So I wanted to ask about investor sentiment, but I guess your title says it all here. Investors ain't fearful. So I guess that sums it up.
No doubt, they were definitely fearful back in October, and actually more fearful back in June and May of last year. But at this point, we've made new 52-week highs in both the name exposure index and the Association of American Institutional or Individual Investors, and so the AAII survey. And the interesting thing to me is, we went from as low as around 12% net equity exposure in the name exposure index, last October, to now over 85%. This is pretty fully invested for this cohort of professional investors. They can get up to 100%. They can even get leveraged, but 85% is kind of normal bullish. Okay, and a new 52-week high in that exposure rate should tell us something that it's risk on in the mind of investors at this point, and no longer are they fearful. In the case of the AAII survey, individual investors are now about 37.5% bulls, 25% bears. That's down from over 50%. I think 57 or 58% was the high in terms of bearish sentiment there. The net bears minus bulls ratio, or I should say spread, is now down, or actually positive, at positive 12.5%. That again is the highest level we've seen since, I believe, November of 2021. So, a new 52-week high to be sure. And, at the end of the day, like you said, the title points out that, investors ain't fearful anymore. That's the bottom line.
So, Jeff, if they're not fearful, how are we looking on a sector basis in the market?
Well, yeah, that's interesting because, survey sentiment suggests no fear, right? But last week, as the market sold off 1% in advance of the CPI number, we saw a clear rotation from a sector perspective off the, high beta sort of areas like comm services and discretionary into, utilities, staples, healthcare, and surprisingly, a big spike up in energy, which was the leader, up some 5%, while communications were down 5%. So big rotation back into energy. And actually, we think it's deserved, as we pointed out in our analysis of crude prices.
And, with all that said and done, let's try and make some money in this market. What are you thinking? Here, you obviously have your top picks. Let's pick out a couple and dive in.
Yeah, normally, as you know, we'll pick out stocks both on the long and short side. This time, we thought we'll take a more of a shotgun approach to a sector call, and that is this energy call. I actually think energy was the leader in 2021. It was a leader in 2022, and based on work that we did at the Luthold Group, these leadership names should continue to be in the top quintile of performers. Okay, so we think energy is going to be a leader again in 2023. It may not be the number one performer, but it might be the number two, and that might be good enough. And when I take a look at all 11 GIC sectors, the one that really stands out as being, in a clear consolidation pattern and poised to break out is the energy sector. It looks like something of a cup and handle base formation. I think XLE is the symbol. It went out around $90 last night. A breakout above 93 would confirm this pattern. It would count to 118. We would use a stop loss at 88, and that would set up a risk skew of positive risk skew of 5-1. So that's a very, very attractive positive risk skew. We like the trade dynamics here. We like energy. We think the fundamentals support it, and we'd take a broad stab at energy with XLE.
That's great. And how about something on the short side?
On the short side, we're going to be more specific. We're going to choose Brown and Foreman, symbol BF.B, the Class B shares. Stock went out around 66. Now, this is setting up as an inverted cup and handle pattern. It's broken its primary trend line. It's built this topping formation that appears poised to break down. A break below 62 would confirm that pattern and project a decline to around $42 a share. We would use a stop loss at 68. That would set up a 3-1 positive risk skew going short Brown and Foreman, BF.B.
BF.B. Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights. It's always an education. I always learn something, that's for sure.
It's my pleasure.
And to our viewers, don't forget you can access Jeff's content on Substack at hugeinsights.substack.com. And don't forget to like and subscribe to Your Finance TV. We're here and we're always bringing you more insightful investment content. So until next time, good luck investing.